sum up our investment approach for the year ahead, we need to build portfolios that do two things. First, they need to take advantage of the growth opportunity that exists in the market today, that economic growth will settle in at an above trend level. The economy should grow at 3 to 3.5% over the next couple of years. So we want to take advantage of that in our portfolios. We want a healthy allocation to risk assets. At the same time, that inflation settles in at a higher rate than we hope, an unhealthy rate, in which case the Federal Reserve might have to raise interest rates faster and thereby ending the economic cycle and causing financial assets to decline in value. So we need to hedge at the same time against that risk. And getting that balance right is critical right now. And we're spending a lot of time these days figuring out the fine details of those investment decisions.
Our outlook for asset classes and our outlook for the markets really ties into these important topics of inflation, the labor market, and those economic cycles. Because most of the indicators we're looking at right now, especially labor and inflation, make it feel and look like we're at the end of the economic cycle, that deceleration stage that usually precedes a recession. However, our expectation is that we expect inflation to slow down. And that means that the economy could be sliding back into the acceleration stage. And in that stage, equities perform very well. They outperform bonds, and that has meaningful impacts for portfolios. So we're optimistic about the performance of the economy and, by extension, the performance of equities. And that's really informing our investment outlook as we go forward. We're optimistic and we're in more of a risk-on position than we would be if we thought we were heading the other direction in the economic cycle.
We are at a fork in the road when it comes to the outlook for inflation. And so at this point in our portfolio strategy, it is critical to emphasize diversification. Now, our base case is for inflation to recede back to more normal levels in 2022. But if we're wrong, in the event that inflation remains elevated but doesn't continue to increase further, stocks can offer a potential offset to inflationary risks. Historically, stocks have provided a pretty good hedge against inflation, in particular if companies are able to pass through cost increases to consumers, like in today's environment, and not get buried by ever-rising wage increases. Stocks can do quite well in a higher inflation environment.
I invite you all to read our 2022 Capital Markets Forecast.